Throughout stock market history, there have always been crashes and corrections, and there always will be. What's more, it's at precisely those times that investors tend to make their biggest investment mistakes. The problem is that human beings are hardwired to recent events. The bigger the event, the more likely we are to react. This graph shows the JSE from 1976 until the beginning of this year. Each of the market corrections have been shown on the graph with a red arrow. You will see corrections ranging from 47% to 22%, and then how long they took to recover and get back to where they were. The longest recovery was 61 months, but the average is around 2 years. The fact is, we can't predict the future, and investors should be prepared for a severe market downturn at any time. The best way to manage this is to diversify and then stick to your investment strategy. Cost averaging is also a really effective way of investing. Cost averaging is a strategy in which investment positions are built by investing equal sums of money at regular intervals, regardless of what is going on in the financial markets. This is how your retirement fund investments are done. You and your employer contribute a portion of your salary into your retirement fund on a monthly basis, no matter what is going on in the markets. Let's look at a practical example of how this works. In this example, the investor is contributing 1,000 Rand per month to her investment. In month 1, the share price is 5 Rand per share, so she gets 200 shares for her 1,000 Rand contribution. In month 2, the share price drops to 3 Rand per share, which gets her 333 shares for the same price. It's almost as though the shares were on sale. If we look at the result after 5 months, we can see that in total she bought 1,343 shares for 5,000 Rand. But the share price is now 7 Rand per share, so the investment that she has is worth 9,400 Rand. But she only paid 5,000 Rand for the shares because of the cost averaging. An alternative strategy to Rand cost averaging is to time the market. Timing the market is an investment strategy whereby investors attempt to beat the stock market by predicting its performance. It's an active strategy that focuses on the short term and requires close attention and monitoring of the market. Some investors choose this approach because if they can get their timing right, they can generate above average returns. However, perfectly predicting the markets continuously is impossible. Rand cost averaging, on the other hand, is a passive investment strategy. This strategy does not require as much attention to the market as you make investments of the same amount of money on a regular basis. Rand cost averaging is also beneficial in that it takes emotional factors out of investing. Since you are regularly making investments no matter what the market conditions are, emotions are eliminated out of the decision-making process. Before you start to invest, there are a number of factors to consider. It helps to think about how much risk you are willing to take and which products match your needs. Additionally, it's not advisable to invest using money that you may need in the short term or to enter into positions that could cause financial difficulties. It all starts with thinking about what kind of investor you want to be. If you would like to chat to one of our experienced financial advisors about making an investment, please get hold of us at Tennant and we will be happy to assist. Thank you.